Hi, and welcome to Symax Fintech's weekly market insight. Before we start, let's just go through our disclaimer. So, trading involves potential risk of loss of capital and is not suitable for everyone. But as I always say, hopefully it is for you. Now, leverage, just be aware of leverage because you can lose substantially more than that initial investment. All the views, opinions, everything that's included in this are just for educational purposes. We're not trying to encourage you to invest or trade. That has to be your decision. And before you make that decision, just carefully consider the risks involved, your financial situation, definitely your level of experience, and also the risk appetite. Of course, only risk capital you're prepared, but more importantly, you can afford to lose. If you've got any doubts whatsoever, seek some independent financial advice before you risk your capital. That's really important. Okay, so highlights of last week. We all thought it was going to be Powell's testimony or NFP. But towards the end of the week, we had more surprises. But let's start with Powell's testimony. So, it remained the same, warning that rates are going to go higher and for longer. Their determination to beat inflation back. And that made the markets sort of lean more towards probably a 50 basis point hike on the 22nd of this month. Now, he's even ready to sort of speed up that pace of tightening if it's necessary, if inflation continues to refuse to drop lower. Of course, the events at the end of last week with SVB, Silicon Valley Bank may change that slightly. I'll go through that much more in the macro outlook. And then, of course, we had NFP on Friday with the earnings, hours worked, and then we've also seen jolts this week and also jobless claims. So NFP came in stronger than expected again at 311,000. And of course, the unemployment rate did increase though to 3.6%. So that was perhaps a little bit of a surprise. And of course, the problem there is that all these jobs that are still available. I mean, it's not a problem. It's a good problem to have that there's so many jobs available. But where are all the workers? And that sort of is still unknown. It just seems that more and more of the 50-year plus guys, maybe mid-senior management, have all decided that they didn't want to go back to an office. So they're either working from home or they're creating their own ventures or adventures or whatever. But so it's difficult. Almost 11 million jobs available. Now, jobless claims also went up slightly. And that unemployment rate rising, just keep an eye on that because if that could continue for a bit longer now. On top of that, earnings fell slightly. The US jolts, as I say, 10.8 million jobs available. The average earnings only increased by 0.2% month on month, which is 4.6% year on year. And another little indicator is that the hours worked dropped slightly. It went down to 34.5. So after NFP, the dollar started to weaken. There are other factors around that with the SVB as well. So as I mentioned, I'm going to cover that a little bit later. And then if we move on to the UK, just to get sort of what happened last week, moving forward, GDP came in surprisingly better than expected. Everyone was expecting maybe that I'm in the UK, so that we were going to enter this sort of technical recession. but we didn't. We came in at 0.3%. So yeah, so we've dodged that for the moment. Now, retail sales, GDP, industrial production, so if you go back to manufacturing and industrial production, then they are still disappointing. That those numbers are still dropping. But we've seen in the shops from the previous retail sales that demand is there. Then if we move on to the EU, GDP again came in a little bit disappointing there. It was flat, zero, which is 1.8% year on year. So, the economy zone's not out of it yet. But, the thing with the Eurozone is the fact that this weather has been, such a blessing for Europe this year. The fact that it's been that much warmer than it has in previous years and seasonally. So it really has taken away a lot of the demand that would have been there, especially if it had been a severe winter, for energy, especially gas. And obviously that would have had a massive impact on consumers taking up more and more and more of their disposable income. It would have given them some very hard decisions, especially when you look at food inflation and such like as well. In Germany, we had retail sales as well. So in Europe, they were down 2.3%. And in Germany, retail sales were down 6.9% year on year. So, it's the European strongest economy, but it's not doing that well at the moment. I'm sure that they'll be relying on the reopening of China to, increase demand again. But, we're going to have to wait and see if that really is the case or not. So Australia, as expected, the RBA raised rates by 25 basis points to 3.6. That could stop or slow down now. Bank of China left rates unchanged. Bank of Canada left rates unchanged. Now, China, they gave their leader another 5 years. It's looking as though he's going to have sort of this life control over the country for the moment. And CPI and PPI came out as well in China. So in China, year on year, CPI was slightly lower. It was 1%. And PPI came in at negative 1.4%. Now, again, wouldn't some of the other central banks love to have that problem of much lower inflation and much lower levels, but that's just not going to be happening for the moment. And then in Japan, GDP came out, and that was sort of pretty flat. They left rates unchanged. They've still got this negative rate that's still sort of pumping into the system, despite the fact that inflation is moving higher, wages are moving higher. They're keeping this loose policy. But of course, they've got a new guy coming in, a new governor for the Bank of Japan now. So, expectations are he may not move very quickly or even at all. But, let's just wait and see, because he may surprise people, especially if the yen starts to weaken again. Okay, so now we're moving on to this coming week. First of all, make a note and remember the clock's changed in the US. So data will come out 1 hour earlier than usual, especially if you're in Europe. Well, obviously, if you're in the US, it won't change. But if you're outside the US and you haven't changed the clocks, such as Europe hasn't, then that will make a difference. Now, what probably the biggest thing, all right, we've got ECB and stuff coming out this week, but really a lot of it is just going to be about the fallout from the SVB, the Silicon Valley Bank. it's going to impact. There's going to be people concerned about the fact that they're, systemic risk, contagion, all of that. But for me, the biggest concern are all the smaller companies that have borrowed money or got loans with them, and that money's still in that account, which they can no longer access to keep their business going and to pay the wages. The people that have invested into them, into SVB and got deposits with them, they're the bigger companies. I'm not saying that they can absorb it or they should absorb it, but it's less of a concern for them. So keep an eye on the smaller tech companies and that, because they're the ones that could be really hurt by this and layoffs. And of course, some of those companies may provide certain components to the bigger companies, and again that can have a little bit of an impact even on the bigger companies indirectly because of that. So that is definitely going to be something that's really going to start to impact the markets at the beginning of the week, starting Sunday evening through possibly the whole of the week. It really depends how the regulators and the Fed and everybody else get involved. But again, another thing to remember here is SVB had quite a spread, broad range and reach around the world, not just in America. So that's going to be sort of some knock-on impact from that. And then on top of that, we've got CPI out in the States, retail sales, industrial production, Michigan consumer sentiment, PPI. So, again, we're looking at the inflation data coming out in the US. Then we've got housing data, we've got the Philly Fed for manufacturing, capacity utilization, which is always one of my favorites. I do like to see, above 80 is expansion. Below probably 74-ish is contraction. Anywhere in between there is okay. But it's a lot of it, if not all of it, is just going to take sort of second place to what's going to happen with SVB. And I will cover that more in the macro part. In the UK, unemployment, weekly earnings, and the highlight in the UK is going to be the budget, the spring statement from the Chancellor. Whether there be any goodies, anything really nice for us, we'll have to wait and see. In the EU, we've got industrial production. Of course, we've got the ECB meeting where rates will go up. Most are expecting 50 basis points, which, Lagarde mentioned even at the last meeting that was the plan. Whether SVB is going to change any of this, I don't know. We'll have to wait and see. And also CPI. So we're going to see a little bit more of inflationary data coming out from the EU. And then in Japan, we've got capacity utilization, industrial production. India, CPI. India, with the population in China going down, India is either on par or may now have surpassed them and become the most populated country in the world. So, it's probably important to keep a little bit more of an eye on India than perhaps we have in the past. Australia, we've got unemployment data, New Zealand GDP. In China, we've got 2 months of data coming out pretty much all this in just 1 week. So we're going to see retail sales, industrial production. They've got manufacturing data coming out, their unemployment, and of course house prices. And house prices to a degree are going to be an important one because the housing market has been very poor. So we'll have to sort of just keep an eye on that. Is there growth really there or not? I mean, I covered it last week, but they've only sort of looked at growth of this coming year of 5%, which I think disappointed a lot of people. They was hoping for a bit higher than that. That doesn't mean that they'll only get to 5%, but that's their target. So they've taken quite a conservative target there, I would say. Okay, so moving on to the macro outlook, inflation is still just so sticky. We've got shortages. Uh, Part of the inflation is greed. These companies, their profit margins are just going higher and higher and higher. And of course, we've all been brainwashed to accept the fact that we've got inflation. Okay, we've got inflation, but a lot of those costs have come lower, but we're still paying the highest prices. So, it's up to the consumers to make a stand here against these companies and this greed, and buy less and make them bring their prices down, as far as I'm concerned. It sort of really irritates me, especially when it comes to the food. Households are struggling as it is. Even sort of the mid-level earners, let alone those on the lower income, and it's just not fair at the moment, I don't think. So, the food giants, because there's not that many that probably really control all the food in the world, plus all the supermarkets, that for me, that they're just really taking advantage of the consumers. Now, as I mentioned already, okay, so we've got data coming out. If you look at what happened to the markets last week, everything looked sort of quite reasonable. Everyone had their expectations of what was going to happen with the central banks as we come up to the meetings in March. Now, things may have changed a bit. If you look at gold on Friday, it moved up over $40. And for me, yeah, there was a bit of dollar weakness towards the end of the week. But for me also, that's a sign of haven trades. That's people, investors, nervous about what's going on, nervous about the banking system, perhaps, probably overreacting there, but to that point. So I think a lot of people perhaps moved into gold. So SVB, Silicon Valley Bank. Now, they made a considerable amount, over 50% of pretty much all the loans that were made to sort of the startup guys, and especially if they was in tech. And of course, they had a few problems. The money was flowing through okay, and it was very quick, the impact. But a lot of it stems back to the fact, and I'll cover this in more detail, that they had invested a lot of that money in treasuries, but when they was at much lower rates. And of course, over 100 billion. So that sort of really sort of stifled them a bit, because, as more and more demand come in for the cash, they would have had to sell those bonds out at a loss to create, to release some of that capital again. So it's not a great position. I mean, it made all the bank shares drop for sure. But I just think overall there's probably a general overreaction there. For me, the biggest concern is, as I mentioned, is going to be the smaller companies, the guys that have relied on that bank to give them investment to, and they've obviously left that money there to draw on as they need it, and now they're sort of losing the ability to do that for the moment. Now, there are lots of venture capitals, other banks, hedge funds that are interested in buying those assets and those deposits, obviously at a discount. And the regulators themselves are involved to try, and the Fed to try and solve the problem. But just remember, this isn't just a situation that is going to impact the US. It could have a little bit of a knock-on impact around the world, but it's also the fact that they are in a lot of other countries as well. And that's, where it's going to sort of make perhaps a slight difference. Canada, UK, China, Denmark, Germany, India, Sweden, and Israel. All, they had offices in all those countries where they were doing business. So, it is going to have that sort of knock-on effect from that point of view. Okay, so I'll probably come back to that and explain that a little bit more about what happened there. But let's get back to sort of, what we were talking about and we know about. So the inflation. So inflation is staying high. It's very sticky. It's not going away for the moment. As I say, I just think that these central banks, given that a lot of it is being driven from the supply side rather than the demand side, it wouldn't be bad for them to just increase their target rate to 3% temporarily. It hasn't got to be a definitive decision, a permanent decision. It's just something that they could do now, which means that they wouldn't have to take those rates quite so high coming up, and it may save them having to drive the economies into recession. Uh, we can't make them do these things, of course. However, okay, so China. Now, China set this 5% growth. As I say, I thought it was a bit low, a bit disappointing. The markets took it as a sort of a little bit negative, really. So it's going to depend on their consumer spending. Now, the Chinese are spending, but a lot of it is on travel. And dining out in China. So it's not necessarily extended and expanding out yet into the global economy. Obviously, those travelling will spend when they get to the other countries. And of course, the weather has helped Europe escape a recession so far. But now, it's all going to just come back to this SVB for the moment. They were one of the top 20 in the way of asset size. They lent to startups. Over 50% of the whole business that, all to the new businesses, startup businesses came from them. So it was a big, big percentage. And not really crypto as such, but that's going to sort of probably get a little bit entangled into it, because there was probably some that was borrowing, that were in the crypto space, but it was very much sort of venture backed for startups, not just in the US though. So if we look at the charts of recessions, perhaps with this going on, they are increasing slightly. The fact that central banks are going to continue to put rates up higher, unless this changes things with SVB, then, that again is just going to push us all closer to recession. This shrinkflation, so where we're paying the same but we're getting less for that, just seems to be in more and more industries now. It's very much in the food industry, but it seems to be expanding out. UK economy still remains quite resilient, though, I would say, which is good. Now, because of what happened last week, the S&P pretty much wiped out all of the gains for 2023 so far. Another good thing, gas prices continuing to drop lower, probably weather-based. So, it's a good opportunity for countries to top up their reserves for next winter. I think sort of part of the expectation is that China would come in as a massive buyer for LNG and gas, which hasn't happened yet, and they would have been competing against the EU. But, there's still time, so we'll have to wait and see on that one. Now, US default is moving nearer, because that comes back to their debt ceiling, which still hasn't changed. Biden's even coming up with more stimulus plans and more for taxing the rich and increasing corporation tax. Now, does he really want to do them, or is he going to use them as bargaining tools to get the Republicans to agree to an increase in the debt ceiling that they desperately need? You know, at the moment, Yellen is sort of manoeuvring behind the scenes between different departments to keep making the payments, but you know that cannot go on indefinitely. That would run out at at the latest in the summer, I would say. Now, Silvergate, so not related to the SVP situation, but again, you know, we had another failure, which was the Silvergate Capital Corp. You know that they're although they were sort of in finance, and they were very much focused on crypto. And of course, once they sort of got into financial trouble, then crypto values dropped quickly. And it's now taken their overall sort of asset value back below $1 trillion. Now, with this bank failure of SVB, could it trigger another recession? Could there be a run on bonds by banks to sort of build their reserves back up? So we could see these yields drop off because demand, you know, if people are nervous, they're going to want to put their money somewhere safe. And if they're going to want to do that, where are they going to put that? They're likely to put that into government bonds because they're going to feel more secure there. You know, if okay, can banks, you know, governments go bust? Yes. Are they likely to? Not as likely. Banks more, obviously. Governments much less. So tech banks and healthcare, you know, again, they're looking probably as the likely candidates to shed more jobs. Now, you know, if we go back to sort of just China and US for the moment, in 2022, trade between them actually increased significantly, despite all this friction between them, especially when it comes to sort of semiconductors and such like, and, you know, of course, information. So now that the sort of Chinese are almost accusing the US of stifling their growth, will this continue, or will that sort of make them look elsewhere for doing business to sort of punish the US? Now, as I mentioned, Biden plans to sort of increase taxes for investors and the ultra high net worth individuals. Uh, you know, it's doubtful it's going to pass though because the Republicans control the House. Uh, so, as I said, you know, for me, all I do is see it as a way for him to use it as a bargaining chip to get the debt ceiling increased, which, you know, uh, obviously Yellen and also Powell just keep mentioning that it needs to be done sooner rather than later. Just going back to the clocks, remember that US clocks changed, they went forward an hour, so data is going to come out quicker. This could be the last time that happens though. You know, there's them and other countries that are saying, you know, should we keep changing these clocks all, you know, twice a year? Why not just leave them as they are? And personally, I would prefer that because oh, isn't it a mess having to go around and change every clock you've got? Okay, the electronic ones do themselves, but anything manual or your microwave and cooker, it's just endless. So, you know, expectations are that possibly now, when we look at interest rates, we could see 6% in the US. I doubt it, but, you know, people are talking it. And in Europe, the ECB could have to put rates up to 4%, which could happen. You know, because they're still behind. They was a bit slower to start. Also, for the ECB, I would expect them to sort of probably accelerate reducing their balance sheet, which is something that the Fed, in my mind, should have been doing for ages, and they just don't. You know, they're so passive when they're doing quantitative tightening and just allowing those assets to mature without replacing them, rather than actually selling many of them down or out, which would, you know, reduce their balance sheet faster. You know, and when it was almost at 9 trillion, they've got a long way to go. You know, at their current pace, it would take them probably about 8 years, I think it is, to get pretty much back out of everything. Not that they would ever do that. I mean, you know, even if you go back to subprime, before the subprime, they still were sitting on $1.5 trillion worth of assets. So it's not just over a crisis that they hold things. And of course, you know, when it comes to sort of these rate hikes and bank failings, it just seems that there's always another crisis around the corner. Now, you know, this SVB, this Silicon uh, Valley Bank, you know, so going a little bit more into the detail here for you guys. So, you know, the funds and the banks, you know, uh, are out there that are prepared to buy these at a discount of between 20 and 40 cents on the dollar. You know, because it's probably based on the expectations that those asset values, uh, you know, once they're sold or all wound down and SVB's closed or whatever's going to happen to it, then that sort of the value of them will be stable. The biggest problem is the fact that, you know, it's the tech industry is the one that's been struggling the most, probably, you know, in last, well, probably the last 15 months. And of course, this is not going to help because, you know, SVB was very much into lending to tech industry, you know, the startups within that tech industry. And you know, as I mentioned before, they were the ones that were lending to over 50% of all the new startups. And again, remember, it's not just the US. This has bigger implications because just to go through them again, Canada, UK, China, Denmark, Germany, India, Sweden, and Israel will all be impacted as well. And governments may have to step in to help out there. Now, you know, when we go forward from there, what's next? Or what caused it? And of course, the problem is that because SVB had all this money, all this capital, what they were doing with a lot of it, you know, why it was just sitting there, was investing it in treasuries. They never expected, obviously, that the governments were going to put rates up as aggressively as they have. So they was long of all these at very low yields, you know, sort of probably, I guess, around about 2%. And of course, we've seen what's happened to them since. So if if and when they needed any cash, they either had to go in and try and raise it, which was what they was about to do, but then they had to stop that because their share price on Thursday dropped 60%. So it made raising capital, through equity raise, just offering shares and such like, impossible. And again, that's sort of how quickly it all sort of unfolded. Now, some SVB clients withdrew deposits, and they did that in the early stages. And of course, every business was trying to do that because they need to keep their business going. And the problem there was that again, that sort of drain down on their reserves was making them to decide do an equity raise, which obviously failed because they didn't get time to do that. Or to sell out treasuries at a loss, just to get some capital in so that they could keep lending. And when it was it was about $108 billion, I believe, that they had in treasuries and bonds mixed. Now, going back to Silvergate here, so Silvergate was different. This is a crypto based, so not really connected, apart from the fact that some of those crypto companies may have borrowed through some form to end up having the loans with SVB. So that's just to give you a bit more flavour on that. So just finishing off this slide. So food inflation is still too high for me. I totally disagree with where these prices are. For me, it's just profiteering from the food companies and the supermarkets. That lack of workers is just doesn't seem as though it wants to be solved. 10.8 million jobs available in the US. It's crazy. But of course, if we keep getting things going on like SVB and rates going higher and higher, then I'm sure we're going to see a lot of those job offers disappear.